Welcome to Books in Sum, your go-to for bite-sized book summaries.
The Ultimate Retirement Guide for 50 Plus by Suze Orman. For the better part of 50 years, Suze Orman has been guiding her clients and readers to financial stability, earning her the reputation as a personal finance expert respected around the globe. Her retirement planning guide for the United States is comprehensive, covering not only the basics, but also the more delicate issues, such as how to deal with financially dependent adult children. The takeaway is that relying on public sector pensions alone makes retirement planning much more difficult than it used to be. There are two primary vehicles for saving for retirement outside of government: employer-sponsored retirement savings plans like the 401 and individual retirement accounts like the Roth Individual Retirement Account. The key message is that retirees whose children are financially dependent on them must use their heads, not their hearts, when making financial decisions for themselves and their children. Considering how much parents and children's relationships have evolved over the past few decades, it's important for retirees to establish clear financial ground rules for their financially dependent children. The author's generation was among those who couldn't wait to move out of their parents' home, but nowadays it's not unusual for people in their 20s and 30s to do so. The key message is to use one's head, not one's heart, when making financial decisions for retirees with financially dependent children. The three rules that should be used as a basis for establishing limits with your children are the most crucial information presented here. There will be no co-signing on loans, and rent will be paid in full as part of the ground rules. Your children should not co-sign for loans, contribute to the mortgage, or expect free lodging if they choose to live with you. Spending less on gas by selecting a more fuel-efficient vehicle is another must. Working longer can significantly increase your retirement benefits, but many people who plan to retire in the future worry about not having enough money to live comfortably. To prevent this from happening, careful decision-making about your vehicle selection is crucial. Saving for retirement is much easier if you can cut your monthly expenses by $500 or $1,000. One strategy is to drive a car for at least 10 years while reducing car expenses through CPO deals and reducing mileage. One more way to save money on housing is to keep living in the same house for as long as possible. Since they can extend their time spent in the home where so many happy memories were made, they will be able to put away more money for their golden years. Saving for retirement is much easier if you can cut your monthly expenses by $500 or $1,000. The most critical information is that reducing housing expenses by downsizing is a good financial move, because it frees up cash that can be used for other things, such as saving more, paying off debts faster, or delaying Social Security benefits until later in life. You shouldn't think about the sacrifices you'll have to make in the short term when deciding to move to a smaller and less expensive home or apartment. Instead, focus on the security and independence you'll gain in the long run. You shouldn't think about the sacrifices you'll have to make in the short term when deciding to move to a smaller and less expensive home or apartment. Instead, focus on the security and independence you'll gain in the long run. You shouldn't think about the sacrifices you'll have to make in the short term when deciding to move to a smaller and less expensive home or apartment. Instead, focus on the security and independence you'll gain in the long run. It's not about what you'll be giving up in the short term by relocating to a smaller, less expensive home or apartment. Rather, it's about ensuring that you have the financial cushion to weather market volatility in retirement. Since 1970, the stock market has experienced 7 bear markets, with an early 1980s investment of $10,000 in an S&P 500 index fund now worth over $30,000 as of late 2019. However, if you experience a bear market in the first few years of retirement, your portfolio may not be able to sustain you for as long as you'd like. Remaining invested and giving your portfolio time to bounce back is crucial to avoiding this. Make sure you have enough money saved up to last you at least 24 months of retirement in case the stock market ever takes a nosedive. The takeaway is that retirement planning requires a long-term perspective. According to studies, it's difficult for us to empathize with our future, older selves, and we rarely consider the costs we'll incur in 2 or 3 decades. Planning for retirement should include anticipating a life expectancy of 95 years and accounting for inflation. The reason for this is that we have a hard time empathizing with our future, older selves, and we rarely consider the costs we'll have to shoulder in 20 or 30 years. Money invested in stocks has historically produced returns above the rate of inflation, while deposits in banks and credit unions have generally underperformed. Money invested in stocks has historically produced returns above the rate of inflation, while deposits in banks and credit unions have generally underperformed. The risks associated with stock market investing can be mitigated with the help of a personal pension plan known as an income annuity. Inflation must be factored into retirement plans if you expect to enjoy your golden years for several decades, as suggested by longevity data. Although stocks can provide a steady stream of income, they are susceptible to sudden drops in value during bear markets. Income annuities are essentially private pensions that can be set up to provide a steady stream of money in retirement, offsetting the uncertainty of investing in the stock market. When you purchase an annuity, the insurance company promises to pay you a set amount each month in exchange for a lump sum that you pay them before you retire. A 70-year-old woman, for instance, would have to spend close to $200,000 as of late 2019 to purchase an income annuity that would guarantee her $1,000 per month for the rest of her life. An elderly couple, say a 70-year-old man and 67-year-old woman, might be interested in securing a monthly income of $1,000 until the death of the surviving spouse. Although it may be unnerving to think about sending off a sizable chunk of change to an insurance company, the peace of mind it can bring is well worth the investment. There is no need to rebalance your income annuities portfolio or worry about bear markets because they are self-managed. Create a will and a living revocable trust to secure your future and the future of your loved ones. It is not wise to use a will to distribute substantial assets like savings and property, despite the fact that it is a legally binding document outlining whom you wish to inherit your treasures. You can fund a living revocable trust by transferring ownership of your assets to the trust after the trust has been established through a legal document. Real estate, financial accounts, and investments are typical assets that you may wish to hold in a trust. It is possible to transfer property between family members without going through probate with the help of a living revocable trust. It also facilitates family life during the deceased's lifetime by designating trustees to oversee the trust's assets. Retiring comfortably and securely requires careful planning and preparation, including saving money now by downsizing your home and car, investing in the stock market to generate inflation-beating yields, and relying on a guaranteed income source such as an annuity to cover your living expenses. A valid will and a trust are two essential legal tools for protecting your loved ones after your death. The takeaway message is to think about the benefits of online savings. In terms of accessibility, brick-and-mortar banks and ATMs can't be beat. However, when it comes to savings account interest rates, they often fall short. Since they don't have to pay rent or other overhead costs for a physical location, online banks and credit unions can afford to pay higher rates of return on deposits.
We hope you found this summary helpful in your listening journey. If you're interested in diving deeper into the topic or getting your hands on the whole book, be sure to check the description below where we've included links to the book and other related products that may be useful to you. Don't forget to hit that subscribe button to stay updated on our latest book summaries. And feel free to leave a comment with any suggestions or requests for books you'd like us to cover. Thanks again for tuning in and happy listening.